Hello, I have been studying Warren Buffett for quite some time. I don't know if you guys have ever seen this, The Intelligent Investor by Benjamin Graham. Well, it was the beginning of like Warren Buffett. It's like the book that he started with as he started building his empire. And then also one of my favorite books is The Snowball by Warren Buffett. And I've read pretty much a lot of these things, almost all of his stuff. And I love the way he simplifies investing and making things very simple for people. So Warren Buffett has I tried to identify like 8 key tips that I took from him that I thought was real important for investors. And one of the big ones that I caught on to was number one is he's really good at holding large amounts of cash to really allow him to capitalize on opportunities when they arise, and also to get him out of jams. And I started thinking through some of the investment strategies that we imply and really understanding your risk to return ratios and making sure that those are right, but using something that's uncorrelated to the market to be able to allow you to capitalize. So most people aren't multi-billionaires like Warren Buffett is, obviously, but they all have a certain human life value, a certain potential. So what we've been doing is using ordinary life insurance, like whole life insurance that has a fixed safety net of a 4 to 5% return after tax. It feels like a 7 if you look at historic from what the compound growth would be. The tax equivalent yield, because there's no tax on it. So if you could store some of your portfolio dollars there that was uncorrelated to the market, so when the market's moving, this money then can be uncorrelated, and you can also use it for whatever you may need. Back in 08 and 09, Warren Buffett was accumulating a lot of what they called death bonds at the time, where he was harvesting large amounts of cash inside these contracts that he would be able to use as like a war chest to go back into the market at a later date. So one thing I saw is like being ready for these opportunities, or more so being ready for when things are getting tough on you to be able to adapt to the changing environment. But if you're insured for your value, because we're not really running these huge conglomerate businesses, but our households are working like a business. So if we're insuring for our economic value, if we've got money that's uncorrelated to the market, so when things are moving, it gives you the ability to take advantage of opportunities when they present themselves. Especially when you get to retirement, if you're starting to rely on your portfolios and those are being volatile, if you pull money out of that, that's like disinvesting. So that money never has a chance to come back because you're spending it down, doesn't have a chance to come back and rebound. But if you have another bucket of cash that's uncorrelated to the market, well, then you can use that to get through on those times. And now you can start using these Buffettisms in your personal life to help you understand how to protect yourself from downside, be ready to capitalize on opportunities, and still earn more than what it would earn like in a cash or a money market type of account, while at the same time protecting yourself. So in my playbook and the Warren Buffett playbook, that's a triple win, right? When you can win in all those different ways. The second thing I thought was real important is just like the book's called, like you got to take advantage of compound interest. So he wrote this book. Actually, I don't think he wrote any of these books, but someone listened to him, wrote it all out. But he talks about this being like a snowball, and that's what the book is called, The Snowball. So it's like wet snow. As it starts to go, it just kind of grows and grows and grows. So if you think about it, if I have $100,000 to invest today, or let's say I have $1 million to invest today, let's use some big numbers. So $1 million in 10 years, that compound effect, if it earns 7%, would be worth $2 million. And then from $2 million to $4 million in the next 10. So you've really grown $4 million in 30 years just by using that compound interest. And that's just piling on top of each other. Obviously, if you have a right strategy, then that would be sweet if you could get that. But compound interest is, and Warren Buffett talks about like being one of the best miracles ever. And he also talks about in the book too, it's really cool. Like he talks about like he wanted to be charitable and give money away, but he knew if he didn't let that money compound and grow, that he could give so much more away, very much more tax efficient by giving it away without paying tax to it. So he's able to build all this wealth by letting it compound and then pass it on to the next generation. So it's pretty cool that he saw the future value of those dollars and the compound interest curve being so much more valuable and more tax efficient by waiting till the end to deliver it. So that was pretty neat. Number 3, be wary of inflation and hedge against it by using stocks. So right now in today's world, we have low interest rates. We have the government pumping in tons and tons of cash into the system. Well, that's automatically going to start creating inflation, right? You can, with a low interest rate, you can buy a bigger house, so that's going to inflate the prices. When you pump money in the system, you have more money to invest. That's going to inflate things. So if you're not owning stocks that will appreciate, or assets that appreciate, like real estate and stocks and these other things, and you're sitting in cash, those values, those dollars are going down. So to participate, you have to put the money to work. So we see a lot of the stock market and all this value and things are happening right now. Well, it's because of a lot of that's the inflationary pressure. It's a lot of that going in. So if you don't use these other positions to protect yourself against inflation, that's where you start to miss out on a lot of stuff. So we have to be cognizant of compound interest and inflation and those things. So number 4, pay attention to the Buffett Indicator. What is that, you may ask? This is a good one. It's the ratio of the stock market cap to GDP. And so you have a stock market capitalization of a certain stock, and then you have what it is relative to GDP, which that means is like whether the stock market is overvalued or undervalued based off of the prior times. So I think just recently GDP numbers came in a little bit off, and you saw the market just kind of come down, because that's a big thing to look to, like when you start looking at the way the market's going to go. So those are like something that you start thinking of. And also another thing that I really liked in here is like when I look at a stock, I love looking at the price to earnings and just really understanding what the price of a stock is relative to the earning. So it's like if I'm going to earn a certain amount of return, that gives you a ratio. So if it's like a PE ratio of 14, well, that's a good return versus a PE ratio of 5 or 2 or 3 or none, right? As you start to look at the stock, but it gives you like a good thing to look at. So what's the price to earnings? And then also like return on equity. So what's my rate of return on equity? So you start to look at like what that is. So like a return on equity actually would have a higher price, a higher number for return on equity than it would be for price earnings. But anyway, that's something very important to look at as you start to look at different stocks. So the next thing is, so you want to hold shares is like holding a business. So if you think about it, if you're going to buy a stock, like one thing that he did quite a bit in here is he read financial statements. And Benjamin Graham said, hey, you read the financial statements of the business. And I read Amazon's financial statement not too long ago, and it was just absolutely amazing, the things they were doing. And at this time, like, you know, with the whole COVID thing and all that was going through, so they're like, all the different things that they're doing within just to get the company moving. And it's like, it tells you a really good story. So when you buy a stock, each one of these stocks have a financial statement. They have an earnings report. So you actually look at it as you own the small share of that business. It may be one share, maybe 10, maybe the whole company. But think of it as like owning a business when you actually do those types of things. And number 6, self-discipline is absolutely vital. You have to have self-discipline when you invest. You have to have a rule. You have to say, hey, I'm in it for the long haul. This is what I'm approaching to do. These are companies, or these are strategies that I can really get behind. Whether it's like an evidence-based strategy we do, or it's a stock strategy that we'd have put in together, or how you're doing it. So that self-discipline is sticking with that strategy over the course of time is better than not having a strategy at all. And I found that to be very true. So I'd rather you have some type of strategy that you stick with and go through. And that's more important. So self-discipline is very vital. Number 7, you have to control your emotions. We've seen numerous times where the market starts to get choppy and things are happening. Your emotions are so important. How you control them, how you make decisions around those emotions, and how you don't lose control of yourself during those emotional times. So understanding your emotions, keeping control of your emotions are absolutely important. And then number 8, watch for stampedes. I thought this was a really good one that I pulled out. So stampedes are happening very much so every day. Back in 08 and 09, they had these algorithms that were going, and they have the the electronic boys, the smart boys. You got these electronic quant traders, and anymore, the market moves by the minute. You got these day traders that are trying to move by the minute, by the hour, by the day, and they're focused on making things happen. So these are stampedes when you see huge streams of float coming through in the markets at certain times, which artificially change certain things in that short period of time. So we just have to know what those are, to really understand what the underlying issues are at the time. What's that company's goal? What's the evidence-based strategy that I have? Am I diversified? Asset allocation has a lot to do with your performance and your growth over the long haul, that if you stick to those things. So those are my, Warren Buffett 8 things to really consider as you're going through. I hope you got a lot out of this, and really excited to see and hear about your investing journey and how you're really going to get money working for you, and putting yourself in the position to become work optional and financial independent. Have a great day, and we'll talk soon. Thanks. Scott.